What's up, everyone? It is day 3 of Module 2. Today, we're going to talk about retirement planning. It's a very important topic. Perhaps, other than learning how to budget, I think the most important lesson in this entire course. So you'll want to pay attention, take good notes. I think you'll definitely use this material once you finish the course in your everyday life and financial decision making. So here we are. What do we need for today? Come over here, Module 2, Day 3, lecture materials, only the PowerPoints. But I do want to tell you we're skipping to 14. So we've been kind of in the early chapters of the book. Now we're in Chapter 14 for retirement. It is 14, 1, 2, and 3. Section 4 is on annuities. We won't cover that. However, this is one of those lectures where we're going to go through the workshop at the same time. So go ahead and download Day 3's workshop for retirement need. And we'll work through that as we go through the lecture. Okay, cool little quote. Winnie the Pooh, don't underestimate the value of doing nothing, of just going along, listening to all the things you can't hear and not bothering. Well, that's not an option for most of us who are still trying to work hard and get where we're going. But it would definitely be an option for us in retirement if we plan well and don't have to work. So that's what this chapter is all about. It's going to be in 2 parts. The first part, I'm going to teach you how to estimate your financial need in retirement. What's your number? Have you ever heard somebody ask that? Hey, what's your number with regards to retirement? Well, that's asking how much do you need to have saved by the time you retire to be able to retire comfortably. So we're going to figure that out. The second thing we're going to look at is once you figure out what your number is, there's a bunch of different ways you can save to get there. We're going to talk about some very popular ones, 401k and Roth 401k being the most important employer-sponsored plans to save your money. And then IRAs, which also there's an IRA and a Roth IRA, being self-directed or individual retirement plans. So if your employer doesn't often offer one, retirement plan, you can take out an IRA. So we're going to talk about those 2 things, those things at the end. Here we go. So where do people screw up planning for retirement? Well, the first way they screw up is they don't actually have a number, so they don't have a goal. That's going to be different for you all because we're going to figure out your number. But the second thing they do when they're trying to get there is they start too late. So I want to provide an example here. What you hear a lot of college students say is when they get their first job is, hey, I really don't make a lot of income right now, so I'm going to wait. I'm not going to start saving for retirement. And so you say, okay, well, I'll wait till I turn 30, and then I'll really start saving for my retirement. That is giving up those 8 years is crucial to your end number. And so we're going to illustrate that with this little drill here. So you graduate at age 22, you begin saving $500 a month. You plan to retire at age 67. You expect an annual interest rate of 4% compounded monthly with your investment. And so we'll talk about, actually next class, how we might come up with something like that. But we'll assume our investment's going to earn 4% annual interest rate compounded monthly. What's the impact of waiting until you're 30 instead of age 22? Well, let's go get our calculator. So in that first example, you're 22 years old. You want to retire at age 67. So that is 45 years. But we're thinking months here, right? We're thinking, saving $500 a month. So let's multiply that by 12 because we need the number of periods in months. 540 periods. Okay. My interest rate is 4%, but we're compounding it monthly. I don't have anything for a present value that's already set at 0. For a payment, you are putting in $500 a month. If you have the BA30, the financial calculator, right, you would put that negative for cash outflow. And then we just want to compute our future value. $754,734.87 in retirement if you start at age 22. So let's record this. Here, I'll put it anyway, right there. Okay. Instead, let's suppose you wait until you're 30. So instead of having 45 years, you only have 37 years. Again, we want to put this in months. So there's 444 months as opposed to 540 months. Let's see what the impact is, all else the same, on your number. $507,322.06. So by choosing to wait just 8 years, you give up nearly $250,000 of income. And so people say, well, yeah, I also didn't invest $500 a month. Well, how much actually is that $500 a month? 500 times 12 months, that's how much is going into a year, times 8 years. $48,000 is what you would have invested over that time period to get $250,000 more. So a significant increase in the value of that $48,000 because of compounding interest. As a young person, you have the best thing ever in your favor, and that is time. Older persons will tell you, I wish I would have saved more earlier because they can't get back time. Okay. Starting too late. We can also save less, save too little. And so if you want to check that out, let's suppose that you make a concession with yourself, and I'm going to bring this over here. So you start at age 22, save 500. What's the impact of saving $400? Well, we could do another change here. So let's get this back to 45 years times 12, 540. And let's change our payment though. Instead of putting 500 in a month, we're going to put 400 in a month. What happens? Well, you know we're going to earn less, but what's remarkable is because of compounding interest, how much less? So we lose about $151,000. And the difference here is we didn't spend $100, right? We saved $100 each month. Well, 540 months times $100, $54,000. It's not a small amount of money, but you could have turned that to 3 times more because we were $150,000 less, right? 3 times more. That money triples for you. Okay. So we save too late, we save less, we save too little. The last thing is investing too conservatively. So for some reason, my parents and a lot of the older generations are obsessed with really safe like CDs and stuff at banks, like brick and mortar stuff, and they're concerned about investing in things that are less tangible, like the stock market. But this is a big mistake with your financial planning. Even if you are worried about the churn of the stock market, over time the stock market's always up, and that's because the stocks are always based on companies' earnings. And while one company goes down, companies on average continue to produce profits, or they would shut down. So if we look at the 20-year returns on stock investments, so this is like if you in 1970, if you put an investment in on stocks 20 years ago in 1950, the return would have been around 10%. So you look at this, and I've been using a 4% return, and you can see that even though there's fluctuations in the market, earnings are always positive on average, right? For 20-year stock investment, you always get something back. But on average, the investments tend to come back around 6 and 7%. And so how big of a deal is that extra percentage point or two? So I'll go back one slide. We were looking at an interest rate of 4%. Let's consider if instead we earned the market rate of 6%. And let me see if I can bring this over for our reference. So here This number is at our 4% interest rate. Let's see what we get instead by investing something in something that might be like a Dow Jones just stock market mutual fund invested in the stocks to track the market rate. 540 periods. Let's take it back to $500 a month. My interest rate now, instead of being 4, is 6%. Convert that to monthly. Present value is 0. Let's see what we get. Boom. Big difference when we look at differences in interest rates, right? If we stay conservative at that 4%, $750,000. But if we get just 2 percentage points more by investing in something a little bit more aggressive in the market, you get $1.3 million. Quite a big difference for the same level of financial commitment, just making a choice to accept a little bit more risk. Now, I mean, of course, you want to make investments that fit your risk profile, but in general, sticking your retirement into a very safe, I don't know, bond fund. It's always going to be there, but it may not get where you want it to be. So we're going to talk about that decision making too. You'll look at your risk preferences later and think about what you might want to invest in. All right. So after that, we now are going to move into our workshop, estimating retirement need. So we are going to find your number. And you'll see that estimating income needs comes with 4 steps. The first, what are my expenditures? Right? How much am I going to need to pay for myself to live in retirement? The second part is, well, do I have any income already when I'm retired? You take the difference, and that tells you how short you are. Like, how much do you have to save to cover that shortfall? We inflate it so that we're talking about money at the time you'll retire. I think if you look back at college 50 years ago, you would find it the sticker price a large bit lower than what you're paying today. And a large reason for that is inflation, right? Prices go up over time. So we want to inflate our shortcoming to not today's values, but future values. Otherwise, we won't have enough money. And the last thing we're going to do is talk about, all right, given what I need to cover each year in retirement, how do I save to get there? And that's this last part. Now, this is tricky. I'm going to go through it very slowly on when we get to those slides. But you'll want to, read your text, pay attention very carefully, go through the workshop with me to try to get this. So let's start with part 1, though. Estimating household expenditures in retirement. Well, we got to figure out first how many years we have until retirement. This person in this example has 30 years, so they waited a little bit to save, whereas you would probably want to get started right away. We're going to think about our current level of annual household expenditures. So what this means is you go to your income and expense worksheet. Now remember, the income and expense worksheet looked backwards on the entire year and said, where is all my money going? Where's it coming from and where's it going? What you want to do is look at this sheet and say, here's where it's going. And then you want to do 2 things. 1, eliminate the costs that you don't think are going to apply in retirement. So if you don't plan to have a mortgage in retirement, you would get rid of your mortgage expense. So that wouldn't be part of this. You would, of course, get rid of savings because this is all calculating savings. And you might look back and say, hey, I'm not going to have a car payment, etc. Or you might look at your current expenses and decide you want to perhaps have an increase in your standard of living in retirement. So you live a little poor now, but you're doing well in retirement. You might adjust some of these expenses upward. And I think the easiest way to do this portion is to think about, all right, here's how it feels to live today, and these are my expenses. Right? And if you think that you can live a little bit more frugally, then you'll reduce them. If you think you want to live a little bit more lavishly, then you'll increase them. And so this really is not that important, right? What percent of your expenses will you live on in retirement? Just take this number and think about, should it be higher or should it be lower? And that's what goes here. So here we start off with how much expenses we'll need to cover in retirement. I want you to pause the video and go to your workshop now. The first thing you're going to do is that exact exercise. However, I want you to assume you're going to make it to full retirement at age 67. You're not going to retire early, and you're not going to wait to save. So right here, whatever age you're going to graduate at, 67 minus that is the number of years till retirement. I've taken out that 70% or that percentage bar, but think about how much you have written down on your expenditures, your income and expenditure worksheet, and figure out what your estimated annual income is. Do that and then come back to the slides. All right, welcome back. We've figured out what our estimated annual household expenditures are. Now it's time to think about our benefits that we already have in retirement before savings. And so you'll see several things here. People get their income in retirement from a variety of places. The biggest chunk is from Social Security, and I'll talk at length about that, but that is a government provision that pays you retirement funds. You may have some asset income from your investments. You may have pensions from your work. I'll talk about what that is. Some people actually choose to work in retirement. And I want to point out that what this is actually looking at is the average U.S. retiree. So it's not people that have sound financial planning and big retirement accounts. It's the average person in the United States, relying pretty heavily on government savings program. Okay, so what is Social Security? Well, it's sort of a misnomer because Social Security is actually several things. It's part of the OASDI program, Old Age, Survivors, Disability, and Insurance. And so Social Security is not just retirement funds, but it's also funds for those who have spouses who pass, those who are put on permanent disability, and those who need Medicare. But people have slipped into calling this old age part Social Security, right? This is when you ask them about the check they get in the mail monthly when they're retired, it's the Social Security check. So that's what they call it. But the Social Security program is a very old program starting all the way back in 1935 with the idea that the government couldn't count on people to save for their future self. And so they forced them to do it through taxes. Taxes are what pay for Social Security. So you remember FICA from earlier in our tax lecture? Well, where the funds come for Social Security are from you and your employer. And so these are not part of your income taxes. So these are not part of the 1040. You'll see that before, or that on your pay stub, you have a FICA Social Security, and that is paid by the employee. 6.2% is for the old age survivors and disability insurance. 1.45% goes to Medicare. And so in total, the employee is paying 7.65% of their income. The employer is also paying 7.65% of their payroll in taxes as well. So that's how the program's funded. And it's only up to $127,200. After that, you don't pay any more taxes on those dollars above that. Anyway, okay, so you're going to get some Social Security benefits. How? Well, everyone in the United States qualifies if they've worked and contributed taxes for 40 quarters, which is 10 years. And the level of benefits you get from doing that depend on how much you contributed. So if you make a lot of money, you're going to contribute a lot of money. And you're going to get the maximum benefit. And so that in 2016 was $26.39. In 2017, it increases a bit. If you contribute less, then you'll make a little less in payment. And then it also depends on your retirement age. So you get this is the maximum benefit, mind you. So this is somebody who's made a lot of money. But this person would only get this amount if they retire at full retirement at age 67. We can see that you don't get full benefits, but you can retire as early as age 62. But your benefits are reduced by about 30%. So whatever you qualify for, you're only going to get 70% of it. If you retire at 63, 64, 65, you're getting more and more close. You're getting closer and closer to the full benefits until age 67 when you get 100% benefit. The other thing is that you can delay retirement and you get paid a bonus. If you wait from 68 to 70, every year you wait, you get 8% more on your, whether you're at the maximum or not, on your monthly payments. So you can delay retirement and even make more money. We got Social Security. And the way you're going to figure this out on your worksheet, on your workshop, is to use the Social Security benefits calculator. The one thing I want to point out is you have to be age 22 to do this. So if you put in your actual birth date and you're not 22, which is going to be a lot of you, it's not going to work. So just change the year so that you'll be 22 years old. And this is like, okay, I'm retiring it. I'm beginning to save for retirement or whatever at age 22. I'll just put mine in August 28, 1987. Let's say I make $50,000 a year. Okay. If you don't enter anything else, it assumes you retire at full retirement, which is what we want with the workshop. And you want to keep this in today's dollars for now, because we're going to do some inflation stuff later. Here we go. If I make $50,000 and I retire at age 62, I'll make $1,292. If I hold out till I'm 67, I'll make my full benefit, which is $1,846 a month. And if I go till 70, I get a bonus, $2,289. Now let's suppose that I did good. So make $1 million. Well, I'm going to reach the cap. And the cap for age 67 and making that much money is $3,010. But if I wait till I'm 70, I can still get paid a little bit more. If I retire early, I get paid a little bit less. Okay. So that's how you work that worksheet. Pensions. Okay. Pensions are company-sponsored retirement plans. And what we're focusing on in this worksheet specifically is pensions where you didn't have to do anything. You worked at the company long enough, and so they're going to pay you income until you die. These are rare. They used to be more popular way to attract employees. They have been phased out with other types of retirement plans that we'll talk about later, but you may have a pension. And of course, there might be other sources of income you have in retirement. The last line to figure out is the additional required income. So what you take is your need, how much your expenses are going to be in retirement, and you subtract out how much income you have. So this person has 33 in annual, but they need 39 too. Yours is probably going to be a bit more lopsided where you only have expenses and not so much income right now. And so they need $6,200 in retirement to cover the expenses however they want to live. So I want you to go ahead and pause the video, complete item 2 in your workshop. Pay attention to the instructions I have at the top of the page. If ever you get to a line and you're confused, it's probably up here. So take a look first. Okay, so go ahead and do number 2, and then come back and resume the video. All right, the thing that we got to do now is these expenses are in today's dollars, but things are going to cost a lot more 45 years from now. So we need to take this number and move it to a future value. We need to take it from today's dollars and say, what is it going to be several years from now? The worksheet in your book has you use inflation factors. We don't have to do that because we know how to do time value of money, and that's what I want you to do. So how would you use, I just spoiled the answer there a little bit, but how would I use the fact that I have with this person, 30 years until they retire, 5% annual inflation of this amount each year? Could you figure out what the future value of that is? First of all, ask yourself, is that a single sum or an annuity? Okay, let's check it out. 62. So we come over here to our calculator. This person has $6,200 in need as of today. We want to see what it's going to be in the future. There are no payments, right? This is just a single sum, and I want to see what it's worth in future value dollars at what interest rate we had a 5% inflation rate, right? And how many years? 45. Compute future value. Oh, this person they have 30 years, 30 years until they retire. 26,796. That's something, isn't it? $62,000, $6,200 today is $26,000 in the future. Very important that we make this adjustment in our worksheet. So, boom, 26,796. Go to your worksheet now and read through the instructions, get your annual inflation rate, and place it here. There is an opportunity here for me to talk about pessimistic personal finance. We talked about being pessimistic. When in doubt, be pessimistic. If you are uncertain about the inflation rate and you want to make sure you have enough money there, would you estimate it as being a little high or a little low? Well, you would say a little higher than normal, right? Because if it comes in low, then you're good. But if prices increase kind of high, you're covered. So you might go with something higher. On the worksheet, I just give you something that's pretty moderate. But feel free when you're doing this for yourself to be pessimistic where you need to be. That means you might estimate a little higher what your expenses could be. You might estimate a little low what your Social Security might come in, etc. So go ahead and do this. Pause the video and then come back. All right, here is the most difficult portion of this workshop. So we have figured out that when this person is 67 years old, they need 26,796. Now recall, you're doing your workshop for yourself. You're not doing it with these numbers, okay? 26,796 is what they need. You'll need something different. What we have to do is figure out how much I need to save today to cover this when I retire and I'm no longer working. We're going to use time value money again. So let's break it down like this. What retirement looks like is two time value of money calculations stacked on top of each other. Here's today. You're going to save every period until you retire. And that's going to mount in some big lump sum pile. That pile has to be big enough so that payments out of it to yourself when you're old exist until you die. Okay? So what we're going to do is solve this backwards. We're going to say, given I know what my expenses are going to be each year in retirement, right? We solve for that right there for this person. How big does the pile need to be when I retire to cover all of those expenses going forward? Realizing that this thing's going to earn interest even as money's coming out of it. Once you figure out how big that pile needs to be, you pop down here and say, all right, that's how big it needs to be. What do I need to save each month to get that pile? Okay, so this first part here, M and N, deal with figuring out how big the pile needs to be. And so, how can we do this? I know what the payments are. I know what the interest rate is. What this calculation is called is a perpetuity. Okay, so I'm going to give this to you in note form here. This is the present value of a perpetuity. And the formula for that is present value equals your payment divided by your interest rate over 100. And don't worry about the math behind it. You're not going to be able to use your financial calculator for this perpetuity, but that's how we're going to solve for it. So what is our example person's, what does their pile need to be? I've got the answer spoiled right there. But present value equals, well, they need 26,796 each year in retirement. And we're going to divide that by the interest rate they expect to get annually and divide that by 100. So essentially what I mean is that needs to be in percentage form. If we do that, you'll see that you get 446,600. Okay? This person, to pay themselves into perpetuity, $26,796 at a 6% interest rate, needs a pile that's $446,600 big. Does that make sense? What does that mean? Well, we're trying to figure out how much we need to save each year. That pile is actually the future value. That's what we need to save towards. So this is another time value of money annuity problem where I have nothing in the beginning. I save every year until I get to retirement and make sure it's that big. So we have to make another expected return on investments prior to retirement. And that's going to be a little bit higher. So we might take something a little less risky while we're in retirement and something a little more risky while we're leading up to retirement because we really want our money to be there when we're retired. So now we got an 8% return. So if you did a time value money calculation, what would your payments be? Well, we can go ahead and give that a try right now. Pause the video and give that a try. Can you figure out what your payments need to be to get to here? $3,942.33. How do we get that? Well, we know the present value is 0. The interest rate is 8%. Future value is $446,600. And the number of periods is you are 22. Well, for this person up here, they have 30 years to retirement. Yours will be different. And then what's the payment? Well, that's what we're trying to figure out. Right, so we would compute that. So if you pop all those in your calculator, it'll spit out that value. To review, what are your expenditures going to be when you retire? What income sources do you have? Use the Social Security website to figure out what your Social Security will be. And then you have your shortfall. That is in current dollars. You need them in retirement dollars. So we inflate those to this. This is your inflation-adjusted shortfall. Given that, you say, well, how big does my nest egg need to be to pay me this much each month? And then how much do I need to save each month to get to that nest egg? Make sure you give that a go and turn that into the assignments folder. Let's take a break. When we come back, we're going to talk about types of retirement accounts, types of different retirement accounts.